Hi, this is Matthew Cratter from Trader University, and today I want to talk about whether the bear market is over. I've been getting a lot of questions from you guys, so I thought I'd make a video about it. If you're worried about this financial crisis, the bear market, the way the economy is behaving in general, or just want to see how I'm trading, be sure to hit that subscribe button. So today, obviously, another big green day on Wall Street. We're getting good strength across all the different market sectors, especially tech is quite strong. And so I think one way of thinking about this and answering the question of whether the bear market is over is to think of this as being two boxers facing off in a boxing ring. Now, on the one side, we have the current epidemic, and we have all of the knock-on effects that that's causing. A huge drop in GDP, high unemployment numbers. Today we just got unemployment claims soaring to the report soaring to 3.3 million. This is the highest in U.S. history. So there are obviously a lot of problems in the real economy. On the other hand, we do have a strong fiscal and monetary response that's been mounting. It looks like this $2 trillion bill is going to pass Congress. It's currently in the House, and Pelosi's predicting a quick passage. Now, $2 trillion sounds like a lot. It might not be enough. In fact, it probably isn't enough in the light of how strong this economic contraction is turning out to be. So we have this fiscal response, very strong fiscal response, and then we have the monetary response from the Fed and all the different central banks, basically printing money out of nowhere and using it to buy muni bonds, corporate bond, ETFs, treasuries, mortgage backs, and basically trying to prop up the financial markets. So these are the two fighters in the boxing ring. We've got monetary and fiscal stimulus working against the economic contraction and the effects of the epidemic. So let's look how this is playing out on a chart. I like to look at a weekly chart to get the big picture. This is SPY, which is the ETF for the S&P 500, 500 biggest stocks in the U.S. and sort of a proxy for the U.S. stock market. And what's really interesting, you can see where we're trading today. This is the current week, which will finish out tomorrow. This bar will finish out tomorrow. But what I like about this chart is it allows us to see that the current price we're trading at is an area of some controversy. So we first broke above this area and then tested this area in early 2018. And you can see this 260 level really is where it's been happening. So we had all these tests. We had a test in early 2018, and then we had another test of this area in late 2018, early 2019, and we managed to get right back above it fairly quickly after just a small amount of time, a few weeks. And so what's happening here is we took out all these supports in the sell-off of the last couple weeks, and now what we're getting, it looks to me like a dead cat bounce, which means a temporary rally in the middle of a longer term bear market. And what's happening is we are bouncing back up to this area of support. And my guess, and it's just a guess, I don't have a crystal ball, is that this area will become resistance and we will bounce back off and continue. Perhaps, I would expect us to take out these lows, or at least to retest the 220, 218 level, which where we were at a couple days ago. Now, in addition to this, what we're about to see is what's called a death cross on the SPY, where the 50-day moving average, this blue line, crosses below the 200-day moving average. And when this happens, this can be a very good signal for that an extended bear market is in the process of taking place. You can see that when we're in a strong bull market, the blue line should stay above the red line, and the price should be trading above both of those moving averages. Right now, the price obviously trading very, very far below both moving average. So we have this context of this big death cross that's coming. Of course, it could be a fake signal, but I think given the economic backdrop that we're seeing and the size of the stimulus, perhaps, and this is a big question, perhaps not being big enough, that this will prove that we're still in the first or second inning of this bear market. And you can see this from the weekly chart as well, especially if we bounce off of these levels. Now, what a lot of people don't realize is that it's fairly typical in a bear market to have really big rallies. And in fact, you get these multi-day, really large rallies, and especially big one-day rallies, you only get them in a bear market. You can see in a bull market, like we were in last year, volatility is much lower. And you can see the daily ranges for each of these bars is fairly small. There's not a lot of, the pullbacks get bought, but overall, the overall wiggles in the chart are quite small, which is a measurement of volatility, versus the regime we're in now, which just has these amazing moves. These are trading, the whole index is trading almost like a cryptocurrency or a penny stock in terms of its volatility. Now, if we go back and look at the bear market from the Great Financial Crisis, 2007 and 2009, we had a couple rallies. There was one in particular you can check out from October 10th, 2008, where we bottomed at 83.58 on the SPY. In just 2 days, we rallied up to 105.53. That's a 26% rally in just a couple days. So you can see this isn't unprecedented. And then it happened again in beginning off the lows of November 21st, 2008, going to the highs of January 6th, 2009. We basically rallied from 74.34 up to 94, call it 94.45. It looks like that is a 27% rally off the lows. And you can see in both cases, the market continued lower. The lows were not in. And in fact, after you got this big rally, the lows were taken out and we had another, almost a fake breakdown, because then stocks were able to finally recover. But again, to put this in context, this was happening well over a year and a half into the bear market. Right now, it's hard to believe, but it's only been 35 days really since the highs. And so I think it's much too early to call a bottom. So what does this look like if we get a similar bounce of call it 27% off the lows? Well, the lows from the last from earlier in the week were 218.26. That was the lows on SPY. And so if we were to get a 27% rally, which is similar to the size of some of the big bear market rallies that we got in the last cycle, in the last bear market, as we just saw, that would bring us up to call it the 277 level. I think it's 277.19. So this is 277 here. And so I think we could rally as high as that and still be in a confirmed bear market, given a lot of the very dire fundamentals of this economy. Now, we may fail at this 260 level. You can probably hear my dogs barking in the background. We got everyone home, so hopefully you guys can't hear that. But this 260 level is a real area of testing. If we manage to stay above it, I would still say we're in a bear market up to the 277 level. Now, so how does one trade this? Well, everyone's going to trade this differently. If you're a long-term investor, you can be cost averaging. There's no need to panic. If you're looking to look a little bit more about value investing or valuation-based investing, check out my video from yesterday about Warren Buffett and how to analyze a dividend stock to find the levels that are good for you. And then, of course, if you're an aggressive trader, one can possibly put on a tactical short around the 260 level using a stop. Maybe if you're short S&P futures or short SPY, maybe use a 5% stop or so. Whatever. You can basically use a tight stop and take a large position, which is a little bit dangerous in this high volatility regime, or you can size your position a little bit smaller and then maybe use a 10% stop or something like that. Or you can wait until we get up. I think if you get up to in the 270s, the risk reward probably looks a little bit better. Now, if you're stuck at home, if you've enjoyed this video and you'd like to see more of my material, I'd encourage you to check out my courses on my website. I'm going to put a link in the description notes below, especially the course on bear market trading strategies and the two courses on trading, Learn to Trade Stocks Like a Pro, Learn to Trade Options Like a Pro. And your membership will get you access to all courses. I believe there are 12 courses on here right now. Now, normally tuition is just $125 for 30 days access, but I know these are financially tough times for many people. So I'm running a special. Basically, if you click right here, get it now, you'll be taken to this page. And rather than having to pay $125 for 30 days access, if you click right here where it says have a coupon code and enter YT99, that's going to take $26 off and bring the total just $99 for 30 days access. You can watch all the courses, take notes on them, and then cancel before 30 days. You won't be charged again. There are no long-term contracts or anything like that. I just want to get this material out to as many people as possible. If you don't have the money yet to do the courses, check out my books on Amazon. They're all available for just $2 or $3, at least in the U.S. for the Kindle versions. And keep watching my YouTube videos. And in the comment section below, let me know if there's a particular topic you'd like me to cover. I'm trying to also put out as much free material right now as possible. So I hope you are all staying well, staying sane, and negotiating this difficult time. All the best to all of you, and I'll see you in the next video.